Hello, welcome to Any Answers Answered. This month we're going to have a look at a couple of questions from the Any Answers section of accountingWEB. We're going to have a look first of all, Tim, at a question from Malcolm McFarlane, who asked about dividend vouchers. I think the point he's making is that now that we no longer need to tell people about the credit element of the dividend, do we need to do any paperwork at all? And I'm hoping the answer is going to be, yeah, we still need to do the paperwork.
Let me read the question. It's a very brief question. With the introduction of the new dividend tax, is it still necessary to prepare dividend vouchers or notes of a meeting where agreement of payment of a dividend has been agreed? Would HMRC really be interested in seeing them anymore? And you're right, it is triggered, of course, by the change in the dividend tax rules and the fact that we no longer have any tax credit on dividends. So do we need what might have been called a tax voucher? And the answer is yes, we do still need dividend vouchers. I was looking at one website in connection with this that deals with quoted companies, and there the suggestion is that they should now be called a dividend confirmation rather than a tax voucher. But the point as far as HMRC are concerned is that if push comes to shove and they raise an inquiry into a return, they will want evidence that amounts put in the return as dividends were in fact properly authorised, properly voted and properly evidenced as dividends. And there are something like 45 different comments following this question from Malcolm McFarlane, which does demonstrate the interest in this particular area. And it's not until towards the end of those comments that one or two of the commentators have given references to the company law and the tax position and the Corporation Tax Act 2010, specifically requiring that companies do provide shareholders with some sort of dividend voucher. Of course, there won't any longer be any tax deducted, so there'll be nil tax on it, but the voucher will still be important.
And of course, it's important in terms of making sure that it's just an evidence source, isn't it? So the date of the documentation could be important if actually the dividend wasn't paid. We'd be looking at a final dividend there, of course.
Well, another issue is what is the effective payday or tax point, if you like, to use a VAT expression, for dividends? And the answer remains that for an interim dividend, which can simply be declared by the directors, the interim dividend isn't effective for tax purposes until it is actually paid, although the revenue have long accepted that crediting such a dividend to a director's account, assuming the director is a shareholder, of course, would constitute payment as long as he has or she has an unfettered right to draw on that account. But if we're looking at a final dividend, then a final dividend has to be voted on by the shareholders in a general meeting, and the final dividend is then treated as a dividend for tax purposes on the date on which it's declared to be due and payable, because the due and payable day is the date from which the shareholder has a right to enforce payment against the company.
And I would say not only do we want to see the dividend voucher, but also we want to see the audit trail, if you like, of the process that led to the payment of that dividend. So directors' minutes and possibly shareholders' meetings and what have you as well.
And particularly important because, of course, this year, 2016-17, we all now have the possibility of £5,000 of dividends within the zero rate band for dividends. And there will be a temptation to characterise payments, particularly to director shareholders, as dividends within that 5,000. And the revenue will, I'm sure, in due course be querying whether those payments were dividends or were they something else. And the company that has got the proper minuted resolution and the dividend voucher is going to be in a far better position to defend that than the director shareholder who hasn't got any paperwork at all.
Okay. The other question this month comes from Daniel Grix, and Daniel's question actually is something that we talked about on Tax TV this month as well. And relates to incorporation of rental properties effectively. The question has been, since the announcements relating to restrictions of mortgage interest relief, well, if an individual can't have mortgage interest relief, would it not make more sense to go into a corporate structure where I'll keep getting the deductions for my interest? But actually, that is ignoring quite a few points, and also once you do all the maths, probably not worth it.
Well, it does very much depend on the circumstances, and one of the earlier comments in answer to Daniel's question made the point that if you are seeking to avoid the restriction in interest tax relief for individuals to just a 20% credit, which is gradually being brought in from April 2017. Actually, if you put the properties into a company and the company pays the interest, the effective relief by then or by 2020 is only going to be at 19%. But of course, that disregards the fact that the property rental profits won't be taxed at marginal rates either within the company. But that is quite a good reminder that you could just be going out of the frying pan into the fire.
I think an awful lot of people have decided that the restriction of interest that we're used to, that calculation, effectively a P&L and a deduction within the P&L for the interest goes, but is replaced by a 20% tax credit at the end of your computation for tax, which gives you 20% relief on the interest ongoing.
Yes.
And a lot of people have ignored that completely, and which is why people are saying the corporate one is so exciting. But as you say, it'll drop to 19 and then 17%.
I think it's a good illustration of the misunderstanding, misconceptions that abound in this particular area. But it is complicated. The particular circumstance that Daniel raises is one where the individuals have a separate business, a letting agency. They own at the moment 3 buy-to-let properties, but there isn't any, or at least there's no indication in the question that there's a partnership involved. So one issue there would be if you transfer those properties into a limited company, there'll be significant stamp duty land tax. So that's going to be a counter to having it through a company.
Including the 3%, of course, unless there's they're all going in one go.
And it's multiple acquisitions, that's right.
And so the point is, an awful lot of things to consider. Also, capital gains tax, we haven't touched upon. Almost certainly you won't get incorporation relief. Some people will, but very few will get incorporation relief. So capital gains tax, the stamp duty, the difference between income tax and corporation tax not being as much as it was, and add on to that a dividend tax at the end of it, and who knows how much it's all going to cost. Obviously, we'll make sure that when you do receive the dividend from your new property company, you will of course do all the paperwork. We will see you in a month's time for further questions from Any Answers, but for now, bye-bye.